Welcome back. You're watching the special. We're calling it Accounting for Change. What has the first year of the Ind AS rollout meant, and what trends can we expect in FY18? So, Sai, let me talk to you about the very interesting change in net worth that we've seen.
Yeah, very interesting, and I think in a sense contradictory trends, because total assets of companies, of these 72 companies that we looked at, has come down by about 70,000 crores. But on the other hand, net worth of all of these companies together has gone up by about 165,000 crores, which obviously means that the balance sheet size has shrunk, but still companies have done something different to get their net worth up. And
there's this whole sort of move towards fair value. That has played a huge role in this,
Absolutely.
Right?
So some of it is the consequence of adoption of these new standards. So for instance, the fair value use on the financial instrument side. So that's a mandatory requirement that has seen companies net worth going up by about 35,000. But the most important change is on the fixed assets, where companies have revalued their fixed assets, gone up by about 89,000 crores. And most of this seems to be on land. And we've also seen a trend that several other companies have taken a write-down on some of the plant and machinery and other assets, and taken a corresponding write-up on the land. So in a sense, it kind of insulates the net worth, or helps them maintain the net worth, but kind of insulates you from future depreciation or future impairment, etc. So that's an important trend, and I think as companies look at earnings going forward, or you're analyzing company, I think that's an important thing to look at, saying which companies have kind of done this rebalancing of their balance sheet. And
let's actually ask Mr. Unnikrishnan about this. Mr. Unnikrishnan, this concept of rebalancing the balance sheet itself, because of the fair value principles that are being now applied, is this something that you've undertaken as well at Thermax?
Yeah, certainly. We have not taken the upside of it, though we were allowed to do a one-time revaluation of the land and properties of the company. We refrained from doing that because it would have unnecessarily shown a higher valuation and net worth for the company. But on the same time, we have looked at the fair valuation of some of the investments of the company, and wherever we felt the valuation is lower than the stated value in the books, we have taken a negative hit on that. So ultimately, we have taken a hit on the balance sheet rather than taking an upping of the entire value. But we have utilized it for the good for the shareholders rather than inflating the valuation. That we didn't do.
Okay, fair enough. So let's talk about year two and what we can expect from here on, Sai, because year one was interesting. Generally speaking, we had a drop in EBITDA, we had a drop in PAT, even though taxes were down, because there's a greater amount of deferred tax under the new standards. What sort of trends can we expect now? And a word on this ECL, which even Mr. Unnikrishnan referred to, because that is where I'm guessing there are going to be more changes as the quality, the underlying credit quality of the instrument changes.
So as you look at year two, and I think, again, based on our discussion of the number of companies, I think with the year one transition and all these transition options that are available behind them, I think companies are now looking at how this actually impacts the way they do business. So for instance, number of companies that are now looking at joint ventures or any strategic tie-ups are very closely looking at the terms that they actually agree with the counterparties to determine whether they are able to consolidate this business going forward, or they do.
Let me actually get Mr. Unnikrishnan exactly on this. So Mr. Unnikrishnan, in the future, in this year or the coming years, when you're looking at a joint venture, or you're looking at any kind of M&A, has control become very, very important? Would you like to see that consolidation at the top line, or would you continue irrespective and make that a strategic business decision, not necessarily a P&L or accounting factor?
As a prudent practice, we will look at the strategic intent rather than an accounting intent. The moment you look forward to inflating your top line, including a joint venture where you only part on the company, you may have a majority shareholder, you are trying to be giving a wrong impression to the market, at least the investor who may not be able to understand the nitty-gritty of a balance sheet. So I would say the better practice is, if it is strategically important for you to be acquiring a company up to maybe whatever the percentage, that is for a different purpose altogether. If you're having a control exercise on the company on account of the fact that you are capable of managing their organization for its better future, then consolidation do mean something. But just for the heck of having the number added to the top line, I think it will be an unwise decision for anybody to do.
So, Sai, to add to that, capital raising itself. Because the manner in which instruments are being classified into liability or equity, that's changed.
That's right.
Do you see that impacting, capital raising decisions?
Absolutely. So again, just to maybe supplement the earlier point, it's not actually just about seeing how you account for the top line, etc. So companies are actually using this accounting trigger to renegotiate terms to actually get to a better position in terms of actually having control. Because earlier, all that the Indian company was looking at is if I have 51% control, then 51% equity, then I'm okay. But today, they're actually renegotiating to make sure that they have control in substance. Similarly, when you're looking at funding arrangements, so private equity deals, for instance, that you're doing at subsidiary levels and so on. Earlier, you would give in to whatever rights the private equity investor asked for. But today, you're very careful in terms of what rights you give up, because if you give them any participative rights, then you don't get to consolidate that particular entity. So companies are actually renegotiating the substance of some of these arrangements and the kind of rights that are attached to that. So in that sense, it is changing the way some of these funding transactions are being looked at. And similarly, the structures that are being used are also being relooked at. So for instance, earlier if you gave put options from the listed company, today you actually relook at it because a put option immediately leads to that instrument getting classified as a liability and so on. Yeah. So it's actually changing the way you're negotiating some of these funding arrangements, and I think you'll see a significant change in the way companies are doing business.
Okay, so, Gautam, I'll get you in for the last word. With all the changes that we've seen, and we'll continue to see more companies get added in, for you, what is it within Ind AS which has been most significant purely from a corporate balance sheet or a P&L analysis point of view?
Sure. So there are 3-4 aspects actually. One is the debt, the way you look at debt for companies which have a lot of joint ventures and associates. Second is the change in net worth, right? The cash-rich companies, the dividend treatment, all of that. So that is very important to focus on. And third is, we didn't touch upon it, but the fair value of ESOPs, right? Yeah. Companies in consumer sector, auto sectors, private banks. I mean, private banks are still not part of the Ind AS, but at some point of time they will be. So ESOP treatment also, how the employee cost changes, and therefore how does that impact the profitability? That is the third part. And fourth, obviously, the cash flow changes. I don't think that is too big a impact right now, but eventually market will look at that. So those are 3-4 changes I think will matter. Debt, net worth, ESOPs, and the whole this consolidation business changing into the equity accounting method.
Okay.
Because it has impact on the way you use valuation tools, as we argued in the beginning.
Okay.
Right?
We move forward, and I think this is going to be an interesting second year of implementation. Gentlemen, thank you so much for joining in. Mr. Unikrishnan, thank you for taking out the time as well. That's it on this special Accounting for Change.